Hello and welcome to a fresh new edition of Taking Stock, the show where we look back at the week which has gone by, tell you what were the highlights, what went right, what went wrong, but more importantly, a show where we look ahead into the week which is lined up in front of us. I am Prashant Nair. Let's tell you straight away in terms of how the indices performed as far as this week gone by is concerned. I mean, for the large cap indices, it was a pretty flat week. The Sensex, the Nifty, the Bank Nifty, nothing, absolutely nothing, flat changes. But the pain on the mid cap and the small cap indices continues to be quite immense. As you can see, both those indices closed in the red. Had it not been for the late recovery that we saw on Friday's session, and there was some aggressive buying which happened on Friday in mid caps and small caps, the losses on those two indices for the week, Friday to Friday, would have been even worse. But the pressure, as I said, continues. I mean, while the Nifty, the Sensex already made a new high, the Nifty is about 2% away from its lifetime high. The mid-cap and the small-cap part of the market remains between 20 and 25% away from their respective peaks, the theme which we've been highlighting and how divergent these two markets have been, almost like you're looking at two different markets. All right, these are sectoral indices, sectoral performances, nothing to write home about. The top loser, I mean, the group of stocks where there was maximum pressure, the metal index, real estate down 4%, the pharmaceutical index down, autos were down about 2% as well. Nothing large or no meaningful sector did remarkably well today, so I'm limiting myself to losers. Okay, so this is as far as the week gone by is concerned, but let's look ahead. I mean, that's what we try and do here in terms of the show. So, I'm going to keep the noise aside and look at the big indices. The big Pied Piper for global markets essentially is the S&P 500. The S&P 500 remains strong. You look at an important level, which is 2,802 on the S&P 500. As we've been highlighting, that index took that level out. It's the March high. It's also the neckline of a double bottom. The S&P 500 took out that important level. It continues to be above that level. That's point number one. For global equity markets, there is no bigger or more important index than the S&P 500. Oil, I mean, it's especially important from an India perspective. Even trend-wise or trade-wise or momentum-wise, it looks to be heading southwards. Last week, oil lost 5%. This week, it was down about 3%. Actually, it was down over 3%. Again, Friday to Friday. So that's the other big important factor. So equity markets, I mean, the big equity index looking up. Oil, which is the most important probably macro variable for India, looking down. Weakness in base metal prices, especially base metals like copper, very, very pronounced. So, I mean, that's the setup as far as prices go on important indicators. Now let's come to some subjective matter. The first one is Trump's comments. I mean, President Trump essentially weighed in on interest rates. He doesn't like interest rates going higher. Markets reacted, but that reaction got faded pretty quickly. He's also now saying to a CNBC network interview that he's ready to go full-blown trade war with China. He's ready to tax all the $500 billion of imports that came into U.S. from China. Markets are reacting. How much will they continue to react is the question. Will it be the same as we saw when we came on Friday morning? Reaction in overnight markets on Thursday to Trump's initial remarks, and then markets kind of shrugging it off. Is it going to be more rhetoric? That's the big talking point. Risk of trade and currency wars and dollar strength. Mind you, U.S. dollar continues to the trajectory for U.S. dollars continues to be very, very strong. That is, I mean, by and large, negative news for emerging markets, and one doesn't see how that is going to be different. So that's the second indicator to be kind of wary of. Potential slowdown in Chinese economy. I mean, that's point number third. A lot of talk around it, but no conclusive evidence so far. And the last one, is the yuan really going to the 7 mark? I mean, we're at about, 6.8, 6.85, and more and more voices, commentators saying that we may be finally headed to that 7-odd mark. And what that would signify for the rest of the globe is a matter of subjective analysis. With that brief look back and look ahead in terms of factors which are important, let me welcome in Andrew Holland, who's with us right now. He's with Avendus Capital Alternate Strategies. Andrew, thank you very much. Appreciate you joining in, and thanks for your time. We spoke with you on the 8th of June, our last conversation. At that point, you said that you can't get excited about markets at current levels. Has that view changed at all, Andrew?
No, not at all. And I just listened to your kind of introduction as well, and I can't remember what positive point you made. about the factors, affecting, markets both here and globally. So, I'm sure you commented on many times, but the index is being led by a very small majority of stocks, and once that party is over, then where does the index really go? Because the laggards really don't have much weightage, to support the index. So we're just sitting around, kind of waiting for the penny to drop. That there's quite a lot of things out there which should be a lot more scarier to the markets, but it's just not happening. And I'm still of the view that there's, from our perspective in India with the oil price, yes, it's come down a bit, but I think the fundamentals still mean that the oil price is going higher going forward, because if you listen to what the Fed chairman's saying, he's saying growth is good, inflation's picking up, and the only thing he's worried about is a trade war. So that's the only thing which would, which would kind of uncouple the markets. But whichever way I look at it, it's kind of negative news, because a growing US economy means interest rates have to go up, despite what Trump likes or dislikes. And of course, if you've got trade wars, then that could put the economy globally at risk as well, which would obviously have a big impact on emerging markets. So, it's kind of heads you lose and tails you lose on both growth and any kind of slowdown.
Andrew, you were saying, well, you couldn't really decipher any positive points that I made. Actually, yeah, I mean, true. Negatives outweigh positives. But you just look at prices, right? I mean, the S&P 500, it's kind of sort of continues to march on. I was mentioning that important level it's taken out. You look at the other big variable, especially from India, oil. It's down 8% over the last 2 weeks. Momentum-wise, it's headed lower. How does that fit in with your view?
No, so I think the S&P is still way below the January highs, and I think that's the key point here, despite all the good news that you've got. With Trump and the tax reductions in the US for corporates and individuals, that's kind of played out. The increased oil prices probably meant that a lot of that money savings has gone into paying, more at the petrol pump than it has, into buying goods. That said, retail sales is still very strong. So, global growth and US growth is still there. So, that's what's keeping the S&P a little bit higher at the moment. And of course, you're really factoring in that people are thinking that the trade war is not going to happen. And it's really, a lot of rhetoric from Trump, and they'll come to the table at some point. But, my view is slightly different, is that, who's going to blink first? And I don't see the Chinese doing it. So I think we're going to have to go all the way to something more severe than where we are today, and I don't think that's going to hold up well for markets. As regards the oil price, at the moment, if as we are today, then I think it's really more technical than it is the fundamental part of it, because fundamentally the supply demand is still favouring demand, and of course there hasn't been a lot of investment in exploration over the last 4 or 5 years. So if global growth does continue to pick up, then I'm afraid that oil prices are going to go towards that 90 level pretty quickly from where we are today.
What happens when the dollar yuan, onshore or offshore, hits 7 as a level? Is that going to flash red all over? I mean, how will that be read for markets?
Well, how it was read previously, and was that obviously it makes Chinese goods a lot more cheaper, and therefore they can dump a lot quicker into European markets where there's no trade barriers at the moment, and obviously it's still attractive for even US companies to buy from China. So another 10% depreciation from here is going to be huge. It's like it's really taking some of those trade barriers away. So they're playing a nice game here, and that's why I'm saying that who's going to blink first, and I'm not sure who. Someone has to at some point, and until we do, then we're just going to run into these kind of bouts of concerns over the trade wars and what that could happen in terms of the global economy. But for sure, a trade war is going to be very painful, and it's going to be very painful for emerging markets, including India.
Okay, fair enough. You know, last time we spoke, which is about a little over a month ago, you said markets will differentiate between good quality and poor quality mid-caps. At that point also, I mean, the focus essentially was on this huge pressure that mid-caps and small caps were facing. It's only gotten worse. Where is that differentiation already starting to get made, Andrew, in your eyes, or not yet?
Not yet, unfortunately. I think every stock's kind of being put into the same boat, and obviously some of the better quality companies are seeing a little bit more selling pressure because obviously there's maybe more liquidity there as well. I think maybe after this month and maybe towards the end of August, it's very difficult on the timing. Maybe the mutual funds will have done their kind of reallocations and so forth and so on, along with the SEBI guidelines, and that will ease things off. But I don't see I need to kind of look at mid caps and small caps at the moment. I just let the market do what it has to do, and if you missed the first 5% on some of these stocks, then it's okay. It's in the longer term run of things, it's okay to miss that first buy at the bottom type of approach. So I think there's still more pain to come, particularly if global markets sell off. Then I think you'll see a lot more pressure on the mid caps and small caps.
How is the market, in your view, reacting to earnings? Let's talk about the big earnings which came through the week, right? I mean, Bajaj sold off in a big way, actually. I mean, there's Bajaj Finance then. I'm talking about Bajaj Auto, which sold off in a big way. Bajaj Finance, strong numbers, good performance this week. There was RBL, Kotak, Mindtree. Ashok Leyland was a big one, down 18% this week. Is the market, I mean, the bar quite high for outperformance given where valuations are? And maybe that's the right way to react to these earnings.
Yeah, it's a kind of a reverse of last quarter, right, when I suppose expectations were quite low in terms of earnings. So, that if you met or beat expectations then you were rewarded very well. But since then, a lot of these stocks have continued to move higher. So I think the trend we're seeing now is that if you meet, then there's profit taking in the very short term. If you beat, but you have to beat by a wide margin, that's when you get a little bit more upside. So I think the market's not rewarding as much as it did last quarter because valuations for a lot of these stocks are very high at the moment, and I think that's where we are. And as we said, that it's only 4 or 5 stocks which have led this market, and it's not necessarily because their earnings were great.
Okay, so where, last time we spoke, you were talking about FMCG, private banks. You also interestingly mentioned that corporate capex type stocks could start to look interesting. Again, we've not seen any evidence of that, Andrew.
No, it takes time. I looked at the ABB results and the order book, and margins are looking a lot better. So now whether that's across all the capex type companies, it's difficult to kind of put a broad brush on it. But I'm a little bit more encouraged by what I'm seeing there. But it's not going to be an overnight story. It's going to take a little bit of time, and this is going to play out over the next 1 year. I say it's probably worth kind of looking at them now. I'm not saying that you need to wholeheartedly kind of jump in, but I think nibbling away is probably the right thing to do at this time of the cycle for India. Given that capex will have to start to increase, given where capacity levels are at the moment in quite a number of industries. That said, with quite a number of acquisitions being made through the bankruptcy laws, and some of that capacity is being taken by companies, so maybe that capex cycle gets just delayed a little bit longer than maybe we were hoping. But I think where valuations are, they're worth looking at the moment.
Fair enough. So, I mean, to wrap up, Andrew, any specific opportunities? We know what you like. I mean, corporate capex, private banks, consumption, IT. I mean, the usual stuff. But what should be the mindset really? Protect, preserve what you have, or be opportunistic? What's the frame of mind you have at this point?
So opportunistic is fraught with danger at the moment. I mean, I've one of my favourite sectors to dislike is pharmaceuticals, and it had a bit of a run and has been hit hard again because of the problems that they keep facing. So I think for this month and going ahead, it's really you know, it's going to be really just hunker down and just, you know, let the markets do what they have to do. I think trying to second guess the markets at this point is just going to hurt you, and I think it's been hurting a lot of people. I've just been come back this week from watching England in the World Cup, and there's more excitement there than I can feel in the market, even though you said at the beginning that, you know, we're near to highs. The pain below those 5 stocks is huge. And it's very evident.
And broadly speaking, you believe that the broader market will drag the large cap indices lower, and it won't be the reverse. It's not as if the Nifty is going to pull the rest of the market up with it.
Well, it hasn't done, really, has it? I mean, if you look at it, it's you know, there's only, you know, 4 or 5 stocks which are really helping.
Yeah.
And so the kind of Nifty 50's lost one of its zeros, I think, or the only zero.
It's a pleasure, Andrew. Thank you very much. I hope you find.
Thank you.
You find as much excitement in the markets as you did with the World Cup. Good to have you back. Thanks indeed, and we'll speak again. All right. So we slip into a very quick break. We come back, but we're going to leave you with some market opinion that we got through the course of the week. So listen in. We are back with Ashwini Gujral for his views on the charts. Back in 2.
Money is moving towards IT. Money is moving towards FMCG and consumption. And the bigger trend, the biggest trend I think sectorally right now is financials. Because financials were also performers in that phase. And post-Jan, in spite of the market coming down, financials continue to perform. So the bigger trend in India of financials is still intact. Pharma is still, I think, basing and in the accumulation phase. So you're going to have good news, bad news, good news, bad news. It will take time, but it will not make newer lows.
Liquidity in India is getting tighter. You can see various types of interest rates, money market rates, 10-year bond deals. We've hardened on all fronts. I think there's further RBI repo rate hikes to come. We do have an economic recovery in the last 6 months. I mean, especially on the consumption side, especially on rural consumption, we are seeing a turn for the better. But all we are seeing is a normalization of the economy from the sort of trauma it went through on the back of Demon and GST. We've normalized the economy. I think 1Q we will see good year-on-year top-line growth numbers. But alongside that top-line growth progress, we're seeing input cost pressures come through.
I think overall in the consumer pack, the earnings growth should be fairly good going forward because consumption is looking strong. Rural, even Lever also indicated that the rural demand has been fairly good. And yeah, I think the stocks might, I mean, some of the consumer stocks have done well. I mean, Lever was one of them, but others have also done well.
Welcome back to Taking Stock. You heard from Andrew Holland before we took that break. So fundamentals covered. Let's get to technicals. Ashwini Gujral is with us, and he's going to run us through what he's making of things. Ashwini, thanks very much for joining in. Why don't you set the context, first of all, for the coming week, looking at the way we finally closed on Friday?
Well, the only way today was different was that all kinds of mid-caps, they started to rally in the last 1 hour. Basically short covering, so things like PC Jeweler, BEL, etc. They turned around from lower levels and had a sharp recovery. But other than that, we still remain, somewhat in a range, and the market is slowly contracting a lot, where daily ranges are kind of reducing. So possibly this can continue for a bit, but definitely some of the large stocks, they continue to move higher, like Reliance or Bajaj Finance, etc. So that way, even the lower end does not look like it's going to break. It's going to be an extended period of range-bound trading, maybe 2-3 day worth of pullback on mid caps, but overall fairly sideways and ranging context.
But Ashwini, you're not expecting any meaningful performance in mid caps and small caps, right? I mean, no meaningful bounces, essentially.
See, there aren't any triggers on mid caps. Basically, cost of capital is now off, and till there is elections are around, I don't think mid caps really have a chance, because in these stocks the whole buying has vanished. So either they are sellers or some sort of short covering happens. So I don't think there is an across the board buying that is happening. It's just kind of things get oversold and then there are bounces from the lows.
On the Nifty and the Bank Nifty, would you, I mean, you're not expecting, you're basically expecting them to be ranged like they were this week, but you're not expecting a break down or a break higher?
See, like in the morning, we tested 10,930, 950. That was a buy zone. On the upside, because of any news, if we get to 11,050, 70, chances are we will fail out there and again fall back. So that sort of, 130, 150 point range is likely to continue.
Fair enough. Finally, Ashwini, what would your trades be for the week?
Basically, Jubilant Food, that has given a fresh breakout after quite an extended sideways move. So there you can buy with a stop of 1470, look for 1550. Motherson Sumi, we've been discussing this around 280, 285. That's now getting close to 300. So this is a buy with a stop of 294, target of 310. And RBL Bank, the disappointment on results, etc., is now over. So this is a buy with a stop of 560, target of 585.
Ashwini, thank you very much for joining us. Have a great weekend. We'll see you on Monday. It's also a wrap here on this edition of Taking Stock. Thank you very much. All of you have a fantastic weekend. We will see